Good afternoon, everyone. How is it going? I think very well, right? So, we have been looking into markets also, talking about a lot about markets, other stuff, learning, I think upskilling, upgrading, everything. All of you are spending time here 2 days. Now, this presentation or this discussion for next 15 minutes, it's about the volatility, and now a human factor comes in. We are all humans. So are our clients. Markets are volatile, right? And when markets are volatile, what happens to human beings? All of us are investors, our clients are investors. What happens to them? Emotions, they have emotions. And with the volatility, their emotional thing we have to manage. So it's about that. Now, all of us here have a business of growing money, right? As an individual investor, we are all making money as well. Our clients are also making money. Is it tough? Yes. It's tough. Since childhood, we are studying hard, we are upskilling, we are scaling ourselves, we are gaining the knowledge, right? We worked so hard, 15, 20 years, so hard, and still now, every day out of 24 hours, how many hours are you working? How many hours are you spending at your work? 6 hours, 8 hours? Somebody might be spending more than 10 to 12 hours, isn't it? Out of 24 hours, maximum time we are spending on work for making money. So are our clients. And our job is to grow money, isn't it? Our clients also want that, and that is much more tougher than this. Why do I say that? It looks so easy with numbers and percentages, with the charts, everything, but if you look at data points, now this is a Dalba QAIB 2023 study. Now look at the above bar chart. This is since 1993 to 2022. Now if you look at S&P 500, we say equity asset class has a capacity to give you better returns. Now, out of this entire time period, it has given 9.65% of returns. During the same time, an average equity investor, fund investor, has created a return of 6.81% only. Now, number-wise, this looks very similar, percentage as a number-wise, but it's lesser than the index, isn't it? But we say, as an active investor, you should actually make money more than what indices or a broader market is giving. But numbers suggest it is very close. Now, if we remove the inflation part of 2.50%, you're left out with very less amount as an investor. Now, the numbers grow a little, sad when we look at specific amount. Somebody would have invested, now in Indian terms, I'll not talk in US terms, not 100,000, but $1 lakh, let's say. $1 lakh have become 15,85,000, right? With 9.65%. Now, if you remove the inflation part, you still have some amount. Now, on above percentage part, where clients focus on percentage, it looks similar. But in numbers, there's a huge difference. Looking at an average equity investor, if you remove the inflation part, it's so low comparative to what S&P 500 is. Why is it? Because of the volatility. Because of why people, when they put money in, when they take out money in, they're not able to even beat the markets. And forget about, people who are playing so safe for a longer period of time, just beating inflation. So this is now Indian scenario. Now look as an individual. If you look at how the markets are every day, a lot of people look at the markets every day. Look at, somebody would have invested when the markets are at peak. Most recently, they look at the markets. This is since 2022 to 23, so end of fiscal year 23. 118 times only they would have seen on a positive note, closing on a positive note. More than that, 128 times they would have seen on a negative note market closing. How does it impact an investor when they see more red and less green in their portfolios or in the market? They have huge emotions. So what happens when the markets are up? They are overconfident, right? You would have been getting a lot of calls when market moved up. Let's put more money. There is euphoria. So they want to take excessive risk. But when markets are down, they are stressed out. We are there to again calm them down. We are stressed out, and they start panic selling without asking. So we are talking about now 5 things which we can use to manage those emotions. First one, everyone here creates portfolio. Okay, if you're creating your own portfolio, or if it is already created portfolio. First thing is buying good companies, not only buying good companies, but holding on to it. One of the good example is Maruti. Somebody would have bought in September 2007, 5 lakh rupees invested in Maruti would have become 44 lakhs in September 2022. In these 15 years, this particular stock would have created so much money that somebody would have upgraded the quality of the ride. Not only one example. Somebody 15 years back would have bought, I think everybody, we talk about this a lot. Somebody would have invested in Nisha Motors in September 2007, would have become 97 lakhs in September 2022. Economy to luxury. One paint company, 20 years back, somebody would have invested, rather than buying the house and creating a lot of assets which they don't require, rather than that, if would have invested in this Asian Paint in September 2002, would have become 3.84 crores. That is 192 times in these 20 years. It's not only buying good companies, it's about holding on to it. Holding on to the growth cycle of those companies. And with that emotions, we don't have that patience. We have to give that patience to our clients. Second is herd mentality. We know about herd mentality, but it is real, isn't it? It's very much real. We have seen Bitcoins. People, if somebody would hear that again Bitcoins are going up, still people will think about it. So if there is something new, people start moving towards it. And if there is panic, they start selling. So we say, even if you're bullish or you're bearish, both times market gives you opportunities to make money. Otherwise, you'll just get slaughtered as an investor. This is what happens to a human psychology. So somebody would have bought red hot when the markets are high, and when it would have little bit come down, people would say, now it has come down, let me buy a little bit more. Average it out. And then it slightly goes up and people feel that, oh my God, I'm so right. I bought at the right time and I averaged it well. And look what's happening. And then suddenly the stock or a portfolio starts coming down. People start thinking about what's happening in my portfolio. So let me cut my losses. Markets suddenly further goes down. And then there was a time when it will become into bearish mode, and the investor would have become a bear investor kind of, would have sold everything. And then again, after they would have sold, market starts moving up. Think about the emotions. What's happening to this person, to the client who is calling you when the markets are going up and coming down? They say, now I'm going to become a trader. Let me short the market. Whenever I buy, market goes down. I'll short it. When they short it, it goes up. And then, no clue what's happening. And at the end, this particular investor will say, this is not for me. Markets are not for me. Right? So this is what's happening in a client's mind. Third thing is, a lot of people make plans. Very less people stick to it. If somebody would have stuck to the investment plan, they would have made money. Now, in 20 years, so if you're talking about Nifty returns or Indian market, in 20 years, 18 times, that is 17.60% of return. In 30 years, again, 16 times, 11.26%. Somebody would have stayed invested. But that doesn't mean that when you create a plan, you cannot modify it. You can always modify it. But you should not exit early, right? You can use those data points when you're talking to those clients who want to exit and book their profits and the journey is still on. We can use these data points. So we say, fourth particular tip which we can talk to our clients is nobody should try to time the market. Now, Sensex has given compounded return of 14.94% from 1991 to 2002. Out of this, a lot of people say that I'll make money on a daily basis. Let me make money on a daily basis. I'll do that better. Now, during this time, only 23 days, Sensex would have hit a 6% kind of return. Only 98 days, Sensex would have hit a 4. If somebody would try to do that, they would never be able to catch that particular 6s and 4s. And if somebody would have just not invested for 65 days out of this total 7,707 days, their returns would have been nil. So if somebody is investing, they should not time the market. Use data points. So these statements are very common. You should not time the market. But we should use numbers, data facts, and important ideas to tell the client. And fifth part, which we are talking about, don't check the portfolio often, right? People look at newspapers, people watch news. What happens? We have seen on the first slide what's happening. There's huge hype, which is getting created, and then they're not able to manage it. And we are not able to manage them then when they are so much full of emotions. So we say it's important to have a coach. On the first slide, we talked about that making money is tough. Everybody is busy in making money. Our job is to grow that money. And we work as a coach. Only a coach can tell how to hit a ball, because this volatile market is going to throw different types of balls, different types of deliveries. How to hit that, that's why we are there, to help the client, to guide them. We are kind of a guiding light. You're kind of a guiding light for the client, a kind of sounding board when they're creating their financial plan. So you can tell the investor that you are there to help them create a logical, rational investment decisions. And so that they are focused on their long-term goals. You are helping them to match the risk appetite with the kind of portfolio which they are creating and control the emotions. Also, at the time when they are actually doing impulsive choices, they're making impulsive choices and decisions, you're there to caution them. And you are there to help them create that unbiased decision, right? So I hope these 5 points are crisp, short, and added with certain numbers and going to help you out when you are having discussions, further discussions with your client, because market will always be volatile. Thank you so much, everyone.